Based on regulatory actions, we're definitely seeing some emerging trends on where the regulators at least think our banks have weaknesses. They still do the tried and true like BSA and some of the other consumer regulatory compliance actions, but there's a couple of really emerging areas that are newer from the regulatory oversight perspective. The first one is vendor management. There's been recent regulatory guidance submitted by both the Fed and the OCC, and we're seeing a lot of regulatory actions that our clients do not have robust vendor management processes. You can outsource the activity, but you cannot outsource the responsibility. So from a vendor management standpoint, we're really seeing just a couple of basic actions that the bank should take, but it really starts up front. It's got to be part of your due diligence and your contracting process. So you have to make sure you select the right vendor, and I think equally important, you have to make sure that all the key responsibilities and activities you expect that vendor to do are clearly articulated in your contract. That way you can hold back and hold them accountable for it. Once you've decided on the vendor and they're up and running, you also need to make sure that you have an active oversight process and that you're really monitoring them, that they're living up to what they're supposed to be doing, but that also from an ongoing standpoint, that they're viable, and in case they're not, you have a backup contingency plan. So vendor management is definitely one of those areas that the regulators are focusing on. But another area is model governance. It used to be that we had 2 or 3 models that we used, interest rate risk and credit. Now it's kind of the big two. Now the definition of model is just expanding exponentially, I think, and it's every single spreadsheet that your accounting department uses, all the way to the monitoring software you use for Bank Secrecy Act and fraud. So how do you manage and govern all that process? Again, I think there's just a couple of key elements that you want to integrate to make sure the regulators don't continue down their path of writing everybody and their brother up for this. Appropriately so, because I do think we have a lot of models out there that people haven't even defined. So the first thing is, do you have an inventory? Do you know what your population of models is? And then do you have a risk assessment process to effectively decide which are the most risky and which are less? Those that are more risky, you want to have an ongoing model validation process and to make sure that they're really operating the way you think they should. And then it's good to have an independent team come in and validate that that process is working effectively. Absent any one of those key elements, you may find that the regulators are writing you up. And I think it's particularly appropriate to make sure you have a good definition of what a model is, so it drives through that whole process. A third area to note relates to Regulation B, or the Equal Credit Opportunity Act. We're used to this applying to our consumer loans and worrying about consumer compliance and are we making sure we get our loan decisions back to our consumer customers on a timely basis. But of course, it also applies to our commercial loans, and we're seeing an increased trend by the regulators in really focusing on the application process for commercial loans. That's hard when we do relationship-based lending and we're always talking to our customers. Once those conversations start to drift into the specific details of that customer's loan requirements, then you may have an application. So it's really important that each bank specifically defines what an application is on the commercial side to them, and then they're able to track and monitor that to ensure compliance with the regulation. Additionally, if it's a commercial real estate loan that's applicable to the Home Mortgage Disclosure Act, or HMDA, you've got to make sure that you're capturing all of that data and able to report loan applications, approvals, denials, and withdrawals. So these are one of the things that the regulators are really starting to focus on. In today's environment of heightened risk governance and risk expectations, there are just 6 simple steps that the board can execute to help ensure that they have an effective risk governance process. The first is it starts at the top. So it's that governance and culture. And within that, it's not only setting the tone at the top and making sure you have all the right structures, but it's making sure you have all the right information. I call it event management. Do you know what's going on at the bank? Mergers, acquisitions, other activity like that. Do you have compliance management? Do you understand what new regulations are happening and what's going on with any regulatory enforcement actions you may be under? And then the third piece is just general cost compliance. Everybody's looking to manage their costs more effectively. Do you know how that's going to impact the board? So first point, governance. Second, do you have good policies and procedures? You don't have to write them at the board, but you want to make sure that everybody else has it. Third is, do you have a good compliance monitoring system? Starting with risk assessments, complaint management, event management, is that process working effectively? Fourth is, are you getting all the information that you need? Again, all the flow of information up to the board at the appropriate level. 5 is monitoring and testing. Is there appropriate activities going on? Your internal audit department, compliance may be doing testing that's testing to make sure everything is happening from a risk management standpoint. The last element, and I think in many respects the most important, is people. Do you have a process to make sure you hire the right people? Do you have a process to periodically evaluate them and make sure that they're doing their jobs effectively? And do you have a process to establish a compensation structure that does not encourage them to take inappropriate risks? If you execute these 6 simple steps, I believe the board can have a good level of confidence that they are executing a risk governance process that will help them effectively oversee the bank.